Today, June 29, FedEx made a 52-week high of $249.99. Just 1 cent shy of the $250 price level, which is very unusual because that's a psychological 250 level, just 1 cent away. So in this video, in order to get a better understanding as to where FedEx will be going, we'll use 3 different approaches to analyzing unusual options activity. The first method, we'll take a look at the unusual options today. And number 2, historical unusual options data. We'll take a look at that. And you'll see how we can do that. And number 3, we'll take a look at the unusual options activity of a correlated stock with FedEx. Okay, so without further ado, let's get right to it. For today, you can see on the options tape, just 7 minutes away at 3:53 p.m., 4,000 of these July 14 247.5 strike puts, paying $3.15. So this is just 15 days away, the July 14s. You'll see here the volume much greater than the open interest, so we know these are opening trades. So we believe they're buying this, and when we analyze this, you'll see that this is a short position, bearish, you can see that the value here, 315, there's 4,000 of them. So $1.26 million, so a large investor with this much capital. So it could also be a hedge on their stock position. And so they are buying these put options. And so that is also interesting because why are they buying these put options now? Because of the potential pullback if they are hedging, right? So either way, this is a bearish position. And number 2, historical unusual options data. You could go to think back. We have been analyzing FedEx, some of these options that have been happening. And so we know that on June 28, here's the date, for the October 20s, there were these 2,300 options on that day, yesterday, for the 240 strike price calls. And for the 260 strike price calls, there were 3,000 of them, okay? And based on our analysis, they had sold this to take profits and closed this, okay? And they had opened this 260 strike price calls by selling them, okay? And so when you take a look at today's data on this, you'll see that the 3,000 is over here for the 260 since they were opened. For the 240, because they were closed, that was subtracted, okay? So they took profits there, all right? So they were selling this 260 strike price call. And what is that? Well, if you take a look at this, October 20s here, if you were to sell that 260, analyze the trade. Let's take the put options out. You'll see that this is moderately bearish. It doesn't necessarily mean it's very bearish as long as FedEx doesn't break this price by expiration, which is 270 over here, then this trade would be profitable. Okay, so they're selling call options to collect premium, so they get to collect and keep the premium of their sale of this. You'll see that by selling the 260 calls, they extended the break even all the way to 270, right? So that is a moderately bearish trade, okay? And for our third reason, looking at a correlated stock, which is one of FedEx's competitors, which you may know, UPS, another of these delivery companies in the industrial sector, same industry. And you'll also see it is quite correlated because you can see the last 4 days, green, 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 green. And when you take a look at FedEx, you'll see also the last 4 days, green, 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 right? So it doesn't necessarily mean that the strength is the same, the level of percentage change is the same. That's where the differences are, and that's why you can use different competitors or other stocks in the same industry to trade and to hedge. This is what we do. And if you are part of our membership program, you'll know that we have some trades right now with Carnival Cruise where we're using Norwegian to hedge our trades. So, and you'll see that if you are a member, you'll see that that's been quite profitable because we're net profit with the Carnival Cruise trade, while hedging with Norwegian because of the way the prices were moving. Okay, so when we look at the unusual options for UPS, you'll see today also, July 14, 170 strike puts. Okay, so they're buying these 170 strike puts. When we take a look at the July 14th, the 170, there's 5,000 of them being opened here, greater than the open interest. Okay, so we know that they're bearish and on this stock as well. So you'll see that here. So that's 3 approaches to using unusual options to determine and get an idea of where stocks are going to go. Okay, and so if you are interested in other stocks, you can click our channel homepage, click the join button for more info on our membership. We show you how we trade based on unusual options activity, and we analyze other stocks so you can use to diversify your portfolio. And as I mentioned, for example, we were using other stocks that are correlated. We also analyze and go more into sometimes the historical data. Sometimes we don't cover that because of the time in making these videos, but that's part of our entire analysis. When we make trades, we base it on unusual options activity for previous days in the past as well, not just today. It is just easier to show what happened today, but it is also very relevant. The past data is also very relevant, okay? So keep that in mind, and that's why this type of trading using unusual options activity can be more complex, since there's lots and lots of data as you go back in time as well. So tracking this activity, the data on a daily basis for many different stocks requires a lot of effort. And so this is why this type of strategy may not be so popular, because it's not so simple. Okay, but we try to break it down and try to show how we are doing it in a more simple manner in shorter videos, so we can show you how unusual options is a very strategic and profitable way of making money. Okay, all right, as usual, please smash that like button, subscribe if you haven't, and hit the bell icon. You'll be notified whenever we detect unusual options activity. Thank you, and have a wonderful day.